Testing, testing, 1, 2, 3. All right. Good morning. Happy Valentine's Day to everyone. Hope you've got your flowers for your sweetheart. If you've not got them, after this class is over, but not before, run out and get some. All right. Today we got a good lesson for you. For those of you who are not aware, we got some new people who come and join us all the time. My name is Lan Turner. Put a little banner up here for you. Former instructor at the Chicago Board of Trade and Chicago Mercantile Exchange Education Centers, and I am a current instructor at Utah Tech University, where I teach finance to the adult classes, the continuing education classes. So it's a wonderful, wonderful experience, and I love doing it. And so I like to come in after class and demonstrate a lot of the things that we talk about in class, because we teach night classes. And so we can't do a lot of trading at night, although we are trading with the futures market, and the futures market is trading at night. But we like to come in and demonstrate a little bit during the daytime session when the market's moving a little bit more quickly and can give us some better examples, some better opportunities to trade. So that's why we're here. We're here to kind of continue our learning process from the university classes that I teach. And if you'll notice, up in the left-hand corner, there are no secrets here. We are in a demo account. All right. So we are here for the purpose of learning and education and practice. All right. So we're not trying to dazzle anybody with our great made $10 million in one day skills. We are here to learn. All right. I don't want people to have unrealistic expectations. This is real life. This is what trading is really like. All right. Now, can you scale up and make lots and lots and big money? Yes, you can. That's the whole goal, right? We want to be able to scale our strategies up to the point where we can take larger and larger positions, doing the same thing we would with a smaller and smaller position, and make larger and larger money doing the same thing as we would with a smaller position, right? So we all realize that, and we understand that's kind of the name of the game, and that's what we're looking for. We're just looking for some nice strategies that we can learn and practice. There's lots of different ways to trade these markets. There's no one size fits all. What's works for you isn't going to necessarily work for me. And we talked about this yesterday about my testimony. You're going to work off of my testimony until you have your own testimony. All right. And I'm going to tell you some of the things that work for me. And I've been doing this for a long, long time. I own a brokerage firm. So I've seen a lot of traders come and go. I know what the successful ones do, and I know what the losers do. So I can help you along the way and teach you and show you. I can't do it for you. And again, everybody's going to have a different way of looking at the markets and a different way of thinking about the markets and different risk reward ratios. And they're going to take, different risks, and some are going to have big accounts, some are going to have small accounts. But nonetheless, some of the best things are going to be the same things for everybody across the board. And today, what we want to do is I talked to Bruce yesterday in person, and we had a great conversation, and Bruce has been doing very well. And he's been doing a little bit of day trading with real money. And he's also been doing a little trading with demo money. And he's been going back and forth between the two. For those of you who read the Pitt News Magazine article from Aidan Gray, and he wrote that's how he got started. And he said he was an overnight success. He said it took him 10 years to become an overnight success. And so he's one of those stories where we have him write for us in Pitt News Magazine oftentimes, and he likes to write for us and enjoys doing that. He doesn't get paid for that, so I don't pay him for it. It's all volunteer. Same with Claire Christensen. She's one of our regulars, and she likes to write in the magazine for us, and she doesn't get paid either. She does this out of the kindness of her heart, and she is somebody who's not a full-time trader, but she's great at trading. She understands it. She does it and likes doing it and likes writing for Pitt News Magazine. So we enjoy having those two staff members write for us. I call them staff members, not really staff members. They don't work for Pitt News Magazine. They independent individuals who just like to write for me. And so I appreciate their help, and they don't come to these classes because they're trading. So we don't see them in here following along watching me, because they've graduated from coming and watching me. They do their own thing at this point. But we do constantly stay in contact. We talk to them all the time, and they are great people and um, just enjoy their articles. And Aiden Gray, the point that I was trying to make was that he wrote an article in Pit News Magazine. And if you haven't got Pit News Magazine, oh, that's a great lead in, isn't it? You can go get it over at pitnews.com. And you can get it. The first 3 months is $1. And the reason I do that is because I teach the 2 semesters at the university. I teach the fall semester and I teach the winter semester. And those semesters are 3 months long. And so I want those students to be able to have the Pit News Magazine. They already pay a tuition, so I don't want to have to charge them another fee. So they get the Pit News Magazine for $1 for the entire semester. And then if they would like to continue getting those articles, they can. There's a small fee for $49 for the entire year for the next 12 issues. But as students, they get it for $1. And so that goes out to everybody, not just the students of the university. Anybody who wants to join us here on the YouTubes, then you can get Pit News Magazine for $1 for the first semester as well. So $1 for 3 months. And then if you like it and you want to keep it, then you can continue with your subscription for $49 for an entire year. All right, so jump over to Pit News Magazine. The great thing about Pit News Magazine is that you can listen to it. We do record all the articles. You can read it, so you have the notes there for you. And then you can, oftentimes we have video included, so you can watch the video. And I'm going to tell you, we have a, oh my goodness, the video that's going to be in this next issue, March issue, it's going to blow your socks off. All right. So let's get back to the markets and see what they're doing. The markets take off first thing in the morning, and they like to run a little bit here as the overnight orders are being filled. So oftentimes we don't consider this to be a trend. Not that it can, it certainly can. It can kind of give us a direction of the trend, but we have to realize that the markets oftentimes out of the opening gate will whipsaw back and forth. And they do that because they're filling the nighttime orders. Guys come and they, 12 o'clock at night, they're can't sleep, so they buy some Microsoft stock, and so they put that in there at 12 o'clock, and it doesn't fill immediately, and that then comes in and fills first thing in the morning on the opening bell. And so the market will go kind of crazy as it fills and gets all settled down and fills all those orders. And once that's done, it'll start looking back at the fundamental nature of the market and deciding, are there any news events that we need to take care of, we need to look at, and traders start trying to decide which direction the market's going to go after it does this crazy wild morning stuff. That's why we like to kind of watch it. It's kind of fun to watch this crazy stuff. I don't personally trade real money on the opening bell. I've used to do that and not had a tremendous amount of great luck. It's just a little crazy. It's a little too wild and crazy, even for me, somebody who's been doing it for a long time. And maybe that's, just a little testimony of mine to tell you that, if you're a new trader, you might not want to trade the first, give it 10, 15 minutes, let it calm down a little bit and establish a trend. And then you can start working on that yourself. Start deciding when it's time to get in. So I come and have these classes 7:30 in the morning with you. So I can do this with you. And it's not when I'm going to be trading real money anyway. So I like to start trading after about 9 o'clock my time. I start here 7:30 is when the market opens. And usually if I'm not teaching these classes, I might start about 8 o'clock, 8:30. I like top of the hour. You'll find that top of the hour is a good time to start trading. So I generally like to start trading my own money, real money, around 9 o'clock until noon, my time. I'm in mountain time, so I'm UTC 7. Given the fact that this is UTC 7, let's talk about that. Let's come and look at the news for the day. The news for the day, we're looking at, this is tradingeconomics.com. It's a website I like, called economics.com/calendar. All right. So that's your URL that you want to go to. And then this tells me I just want to look at the recent, and I like to just see 2 impact. I don't necessarily like to look at the single impact. You can, but the single impact doesn't generally move the market, and it just kind of gets in the way a little bit. Not that it can't move the market. The single impact certainly can, but I like to kind of skinny it down and just look at the 2 impacts. So either 2 or 3. So if I hit 2, it'll also include 3, but I can skinny it down here and say just the 3. And so we can see when the big three are. So Thursday, February 15th, that's tomorrow, we're going to have retail sales, and that's a 3 impact. So that's going to move the market. It's going to move the market at 6:30 a.m. So we don't start our class till 7:30. So this is going to be an hour before the class. So you oftentimes see this. They put out these reports at 6:30 in the morning. They do that before the bell rings or the opening session of the pre-market session. And that's when they'll open these things up. So if you want to come in and watch the market at 6:30 in the morning, that's 6:30 UTC 7, which is my time, Mountain Time, then you can do that. If you're further out on the East Coast, getting up at 6:30 and watching the market might not be as difficult for you, but some of you 6:30 might be a little too early. So you'll wait till the opening bell, which is at 7:30 my time. All right. So we're going to come in here and look at 2 impact. And the 2 impact today, we've got 6:30. We had the PPI momentum month over month. And so that's the personal purchasing index, or the producer price index. Purchasing was that's a different report. That's the buyers are buying things. That's a different report. This is the producer price inflation month over month. Okay, so price inflation. Producer price inflation. This is let me see, how do I get rid of this? Go back to there we go. So that was at 6:30 this morning, and you can see didn't really move the market a whole lot. Looks like the market dropped a little bit off of that. And then we have Fed speaking at 7:30, so he's speaking right now. It doesn't look like he's giving us any positive news. He didn't drive the market higher, and the market is actually flushing a little. But we generally see that first thing in the morning anyway, just as the opening bell rings. It'll flush, it'll rally, it'll go up and down a little bit. So I'm not sure how much he's having an effect on things. He's not really giving us any news, like he's not changing the interest rates or anything. Then we got crude oil coming in at 8:30. And if we wanted to go over and watch crude oil and trade a little crude oil at 8:30, would be a good time to do that. Then we got Fed Barr speaking at 2 o'clock this afternoon, and then Bostic speaking at 5. That's not going to do anything in the market. The markets are closed. And so we've got 2 o'clock. That's right. My time. That's when the market's closed. So he's going to speak right as the market's closed, going into the aftermarket session. So that's a little bit of news. So that's what we like to always look at first thing in the morning, see if there's any market moving news. But right now we're just kind of watching the markets flush out of this opening bell. Yesterday was a big down day, right? So we had a big flush yesterday. And so if we go look at the daily charts, we might consider that could be a possibility of a continuation of that occurring. So we have the previous high. This is the Dow. Let's just look at the Dow real quick here. You can see we got our line in the sand kind of drawn across that previous high in there. So that was kind of our base that we built right here. We want to draw a little area of support or area of resistance. It was actually an area of resistance, right? And then as the market broke above it, it came up and it becomes now support. So now the market comes down, and you can see yesterday it came right down and tested that previous high. It came down and landed right on it, touched it, that previous high. So it's using that as support. Now, if we see that in a daily chart or in a 1-minute chart, we get pretty excited, don't we? And the reason we get excited is because, hey, the opportunity is that could thing bounce off of that area of support and start to rally once again. And so maybe we'll look for that. We'll get this ABC, right? This ABC pattern comes back, bounces off that support area, and starts to drive higher. So that's what we're going to be looking at here. If it breaks and comes down into this area of support, it's not going to, we're still going to consider this thing bullish, and it might come down and rally up out of there. At this point, we'll get some green dots, or we might, this is the, actually the bulls and bears is turned on, and I've got those dots turned on. That's the average true range. So this is the bulls and bears. We might see this thing come down and then break those green dots and turn and rally on a break of the green dots. That would be nice to see. It's going to, if it closes below the green dots today, it didn't yesterday, actually, believe it or not. You see it came down, it touched that area of support, and then it turned and rallied, and it closed. Let's bring this a little larger so you guys can see a little better. So it came down and touched it and rallied and closed above the green dots. And that green dot is, in this case, this is the average true range of the market. So it closed above those green dots. Today, it looks like it wants to come down and try and close below those green dots. If it does, we'll get a flip of the average true range. We'll drop below the average true range. And remember, the average true range is not necessarily buy-sell signals. They are indications of the market going bullish and bearish. All right, so we have a bullish, bearish market. I'm going to turn off the bulls and bears right here for a minute. This is what's turning the price bars red, yellow, and green. It's a mathematical model based on Fibonacci. So we're going to turn that off for a second. And you can see that we get the arrows, the flip overs, and I'm using just the ATR, which is telling us the average true range. And so when it breaks above the average true range, we consider the market bullish. When it breaks below the average true range, we consider the market bearish. You can use a second set of indicators to help you identify that. Use some moving averages or something. And we do that sometimes, right? Where we'll come in here, we'll turn on a set of moving averages, and then we can have the moving averages confirm the upside or downside of the ATR. And that's okay too. We do that sometimes. But this is just basically, this is a real basic structure. And so what we're looking for is we're looking for an indication that the market, in this case, is bullish. And then what we like to do is we like to trade little recurring price patterns, like little pullbacks in the market. So oftentimes it's nice to see it break the green dots, but sometimes it doesn't have to. It just comes in here and hesitates. And we get these little red bars like this. Okay, so you can look for a red bar. Generally, I like to see 2 red bars, but 1 red bar, not going to complain. That market took off, and then the next candle to make a new high, that would be your buy signal. So these are not, again, these are not necessarily buy signals. Doesn't mean you can't buy on them. You certainly can. But we like to see and confirm that the market is running. All right. We want to see it move first. It's very difficult to capture reversals. So here's a reversal. You're going to say, oh, I'm going to take a short position. Well, just taking the arrow for a short position doesn't necessarily mean that the market's going to be bearish, because in this case, it came down and just turned around and went right back up again. So that happens on occasion. You say, well, there's a bearish arrow. I'll take that one. Well, it did work for a little bit, but then it turned and went back up again. So not every arrow is going to be a good trade. So what we do is we like to make sure the market's going to move in our favor first, go with the market of the arrow, wait for the market to give us a little bit of a trend, give us this little pullback in here, and then look for the next rally up. Okay. So that's what we're looking for. We're looking for these little ABC patterns. Now, this is just my testimony. You can do what you want. You need to gain your own testimony by doing this yourself, get some experience. I'm going to share with you the way I like to do it. Now, there's lots of different ways to do the same thing. You can do whatever you want. I'm just teaching you the way I like to do it. And so I've been doing this a long time, and I've seen lots of successful traders, and this is how they do it. All right. This is what successful traders do. So they don't necessarily take the first arrow. Doesn't mean they can't. Certainly can. In fact, the autopilot, that's all it does is take arrows. So you can use the arrows. That's, I'm not saying it's a bad thing. I'm just saying it's not what I like to do. I like to come in and wait for the market to prove to me it wants to rally first. And this could be a fake breakout, right? I mean, it could come up just like this one, and it could turn here on this red bar and fall. Well, that's fine because I didn't get in. I'm waiting for it to break above those little spots and then get in up here and prove to me that it wants to continue to rally up to the next little spot. And that's my pattern. That's the one I've had the most luck with. That's the one I like to trade. And there's lots of different patterns. There's not just one. I'm just telling you my favorite one, my A pattern. All right. So this is my A pattern, and I look for this one a lot. This is the one I like to trade. I want to impress you guys, so I don't go off and do a whole lot of weird stuff very often. Sometimes I do. But, you know, if I'm trying to trade my very best, this is what I do. I kind of look for this little ABC pattern. And then I look for this drive to have 3 of those. Okay, 3 drives. Drive 1. We miss the first drive, oftentimes miss the first drive because we're waiting for this, right? Then there's the second drive. I call that the B drive. So this is the A drive. This is the B drive. The B drive is usually the biggest. We get a nice long B drive, usually. Not always. And then we get a little pullback like this. And then that's my second setup, right? So that's my second opportunity to get in right there. And that's the C drive. Now, it doesn't mean the market can't go up and continue to go higher. Certainly can. But I generally like to see 3 drive patterns. And then I look for a little bit of a retracement, a little pullback. I don't want to be going long this would be the D drive. Doesn't mean it can't do a D drive. Just that when it does, I don't like to take it. The reason I don't like to take the D drive is because it oftentimes fails. It doesn't go up high enough to get to break above the previous high and get my stop move to break even. So that's just my basic pattern. All right. Now this is being done on a daily chart. You can see this is how I would trade this on a daily chart. But if we went down and went to a 1-minute chart, it would be the exact same thing. I would do the exact same thing on a 1-minute chart. So this is the Dow on a daily chart. We're seeing it come up. We're giving us this little break. This is what I call an ABC pattern. So again, this is our first drive. We're getting a new drive up in here. So this is our, actually right here, right? Came back, hit this little red bar, that would be a good place to be taking a long position right there, but it failed on us. Came up, tried to go. This ABC pattern failed on us. It doesn't always work. Sometimes it fails. And that's what happens because we're way up here in the overbought region, way up here at top. You can see the stochastics indicators above the 80 line. Those yellow, that red, and that blue and white line up there is the stochastics. And it's telling us, hey, this market's way overbought up in here. Be very careful. Probably wants to come back down a little bit. So we're going to watch and see if it's come back down. How far is it going to come back down? Maybe come back down, bounce off of this. This will give us these two little red bars that we'd love to see, and then go up and make a new green bar, and then go to the moon, and that would be a nice way to see it. Or it may come down here and wander around for a little while, not know what to do. It might kind of, indecision, kind of go sideways a little bit. Can do that too. And that's what happened right here, right? Kind of little indecision. And that's really makes it hard to trade. Lots of topping tails, lots of bottoming tails. That even makes it hard to trade daily in a day trade market. It's hard to day trade when the market's doing this type of stuff. Now, there's different strategies that you can use to make money during a sideways trend. But we generally, when we're day trading, we like to see this type of a market right here, right? So we look at our daily chart to say, hey, are we in an extension market where we seem to be extending and making nice uptrends? In this case, uptrends. So we like big bars. Those make for really nice day trading days. And then, when the bars are tiny like this, that makes for a little bit more difficult day trading day. So we want to keep that in mind too. Yesterday was a great day trading day. See how big that bar was? Even though it closed higher, it went way down in the turn and came all the way back up, gave us lots of opportunities to trade yesterday. So those are what we're looking for. Even when you're getting a little bit of a trend like this and the bars kind of slow down, those are a little bit more difficult to trade. They're still moving higher, but the range of the bar is small. We as day traders, we like these big range bars. Those are big, where they have a big range. That's really nice. We like that. Okay, because it gives us lots of time to move our stops to break even and watch that market extend a little bit. All right, so let's clean up this daily chart and clean all these off of here and realize that's what's going on out here on the daily chart. Go back and look at the rest of them. So the rest of them are doing basically the same structure. This little cousin Russell down here, he always does a little bit different than the other three big majors because he's small caps, where these are all large caps. And of course, these have a lot of overlap between what's in them. So we have to keep that in mind as well. And now let's go back down to the day trading market. So that's days. I'm going to go down to the 1 minute market. So this is the 1 minute chart. All right. So we're kind of settling out of this morning session. I'm going to draw my boundaries up here. This is how high the market went. This is how low the market went out of that opening bell. And you can see it's kind of stuck in a channel. We'll do that on all the markets. We'll come down here and draw kind of these areas of support, these areas of resistance. This was an important place. And we're going to kind of use those throughout the day as gauges to help us identify where these markets like to trade. So we have those on the market. If it breaks below that little channel, we'll consider the market bearish. If it breaks above it, we'll consider it bullish. We also look at that longer term time frame. We also look at the news, helps us identify whether we think the market's being bullish or bearish today, whether it's going to be a big range bar, lots of movement, or not quite so much. And since we're not going to have any red news, right? No red news, we're not going to be considering this market's not probably going to build a huge, big, long trend one direction or the other. Doesn't mean it can't. Something can happen during the day, or some big firm could come along and decide they need some shares and want to buy into it and move the market. So we have to just kind of be mindful of that and kind of be careful, not take any big risks. But I want to carry on with the conversation I started earlier, where I started with my conversation I had with Bruce. Is Bruce here today? I got Michael Bruce. There's Michael Bruce. Good morning, Michael Bruce. There's Bruce. Bruce, we had a conversation yesterday, right? And so I want to carry on and kind of talk to Bruce about his trading. And I want to pull up a slide for you. Now, the markets are moving a little bit. We're just going to I want to do a little lesson today based on Bruce's conversation with me this morning. And let's come in here, and I want to pull up my slides. Now, you guys have asked me if you can have my slides. Okay, I'm going to pull this on the screen so I can point at it. If I do that thing that YouTubers give me over here, I can't point. You can't see my cursor. So I'm going to do it a little bit different way. And this is my slide that I want to talk with you guys about. This is the conversation I had with Bruce yesterday. And Bruce has been doing a little dollar cost averaging. So I want to talk about what Bruce has been doing and teach you a lesson. And so this is called pyramiding. All right. So pyramiding and pillaring. So I want to give you a little lesson quick in pyramiding and pillaring. And we'll talk about what Bruce is doing and how he's building his positions and working to build a pyramid so that he can trade. And I'll show you a couple of things he's been doing, what he's been working on. And I want to kind of example this to carry on our conversation. And this is kind of a conversation between me and Bruce. All right. And you rest of you can listen in, because I just want to kind of talk to Bruce a little bit about what we talked about yesterday, and hopefully it'll help you guys as well. So Bruce has been doing a little dollar cost averaging in his trading, and there's a strategy that I call the Christmas tree and Balaam's ladder. Let's see, is that in here? Here's the Christmas tree. Here we go. Here's the Christmas tree strategy. And this is what Bruce has been doing a little bit of. There's also going the other direction. It's called Balaam's ladder. So if you go up, it's this way. I call it the devil's breath. All right. So if you do this, and I've got that wrong, this is not the cannonball strategy. All right. So this is Balaam's ladder. This means that what you do is you get into the market, and as the market goes against you, rather than just getting out, taking a loss, you start adding in to your position. And there's a number of ways of doing this. Okay. So for example, let's do it to the upside because sometimes it's easier to understand. This is I call it the Christmas tree. And the reason I call it the Christmas tree is because it's green on your screen. And then Balaam's ladder is red on your screen because you're taking short positions, right? So this is the Christmas tree. Now, if you guys want to take pictures of this with your camera, you can pull out your camera and take a little snapshot of that. There's a lot of words in here and you can read that. But if you would like, if you look at the URL up there, I posted this out on the internet. Now, realize that these are just my slides. This is not a book. It's not something that I created for publication. It's just when I have things I want to teach, I need a slide deck, right? So I go in and I create these and I just throw them in here somewhere. So it's not like it's organized in some special order that you just read from top to bottom. It's just a bunch of slides that I use to teach these classes. So it's not the slides from class at night at the university. This is my YouTube slide deck. All right. And if you guys would like to have it, it's 103 slides. You can see right here. This is slide 71. And it's a PDF that's out. I published it. I just stuck it out on the internet so you guys can have it. And just go to pitnews.com/slides.pdf. And you can have this slide deck. All right. So you don't have to take pictures of it. You can have the actual slide deck itself. So go ahead and get that pitnews.com/slides.pdf. So just for coming to this class, you're going to get access to that. All right. So this is what Bruce has been doing. He's been doing a little bit of this. Now, there's lots of ways of building your pyramid or building your Christmas tree. You can, once you get into the market, now in this example, you can see I got in with 5. And that's a little bit more of a cannonball where you get in with a large position size. And then as the market moves against you, you start adding in by 1, by 2, by 3, by 4, by 5. At some point, you have to say, oh, no, this market is never going to come back for me, and I'm going to lose my entire account if I continue doing this. And you sell out. You have to get out. Now, one of the things that people do is they do this and they never get out. And if you're out trading in the stock market, this is called dollar cost averaging in on a downtrend, trying to capture a market as it goes in, and you have longer staying power on a daily chart in a smaller, in the stock market. Oftentimes people will do this for entry and you can just stay in the market and hold on to it, and you're building a position for a growth over time. And it might take 2, 3, 4 months, 6 months for this market to turn, take all of your orders out, and then start going back up, and you're profitable. And that's where dollar cost averaging comes in. And a lot of companies do this. Large hedge funds, large commercial entities do this type of trading. Okay. Let me move myself out of the way here. So this is something that's very popular in the stock market. Now, if we do this with day trading, we have to be very careful. All right. I'm going to tell you, I'm bearing my testimony. You have to be very careful if you do this when you day trade. And the reason is because at the end of the day, we want to be flat the market, right? And let's go back over to the software and I'll show you why. Because if you start day trading and this thing starts going against you and you keep dollar cost averaging in and the market never does come back and give you a reprieve and let you out, look at your key. If you decide, well, I'll just hold it overnight. Well, you go from a day margin, on peak day margin of $100. Well, let's come up here. This is the Dow. That was the micro mini. So you're going to go from a $750 margin, figure $1,000 because some of them are 1,000, some of them are 750. They change. So $750 a day per contract to the overnight contract, which goes to $2,300, and then it goes to initial margin, which is $9,240 per contract to hold that overnight. And let's say you build up yourself a position of 6 or 8 contracts, 10 contracts, because you're dollar cost averaging in and you're waiting for that market to turn and come back, and it doesn't come back. So you're like, well, I'll just hold on to it until it does. I'll hold on to it for 2 or 3, 4 days. I'll hold on to it for a week. That we call that bag holders. You don't want to be a bag holder, because if you wait, if that thing goes overnight, if you hold it past the close and look for it to go into the next day, you're going to go from a $750 margin per contract and $9,240 per contract. And if you have 10 of those, you might be able to easily afford it with quantity 1 or quantity 10 even. But once it goes 10 times bigger, what's that going to do to your account? Is it going to blow you up? You're going to get a margin call. They're going to close you out. You're going to take your loss. So we need to manage that thing so we can be out by the end of the day. We want to be flat, right? Otherwise, you're going to be you'll be in trouble, maybe. All right. So if you're trading in the stock market and you have a cash account, you don't have all this leverage. So they don't let you to keep this massive leverage overnight because it's dangerous. So they're worried you might want to do something silly like go to sleep, and then you wouldn't be there to watch the markets. So they don't let you have that high leverage unless you're willing to sit in front of the computer and manage it. Okay, so that's something that you have to be aware of. So let's come back over here to the charts and let's come in and again pull up that. Well, let me draw you a picture. These markets are just kind of snaking right now. So let's come in here and let me show you a picture. So if you build a pyramid, there's several ways you can build a pyramid. The first one is you can start off with jumping into the market with a whole bunch of money. Let's draw a pyramid in here. I'm going to use this tool. So you jump in with a whole bunch of money, and that gives you a wide base to your pyramid. All right. So let's say you jump in right down here with 10 contracts. Let's just say 10 contracts. All right. And then what you do as the market moves in your favor, you liquidate some off, right? You might take one off here. You might take one off here, 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 take one off here. And eventually, as the market moves, in your favor, you're taking and liquidating positions off, and you get up to the peak of the rally, and you are out of the market. Okay, that's called cannonballing. So I had that over on the other slide, and I was saying, well, this is not cannonballing. Cannonballing is when you get in all at once. Okay, so when you jump in with a huge position and then liquidate them off as the market moves in your favor, that's called cannonballing, or you're building a pyramid. Okay, so you build this pyramid. That's a great advantage. Having a large position and taking them off as you move through time, that's a great advantage. But what's the disadvantage to this? Well, the disadvantage is pretty obvious. If the market goes against you, it doesn't have to go very far. And with 10 contracts on, the market just goes a little bit against you, you lose a huge amount of money. All right. So you lose a huge amount of money. So that's the disadvantage of this strategy. So to avoid that, what do traders do? Well, they say, I'm going to start with a small amount. So let's come over here, and we're going to start with an upside down pyramid. So we're going to start with a small amount, and we're going to go this way with our pyramid. Okay. So this is how we go with our pyramid. And we end up with an upside down pyramid. Okay. And so we start down here with 1 contract, or maybe 2, 1 contract. And then as the market moves in your favor, you add in, right? So you come in here and you add in. Now you got 2, now you got 3, now you got 4, now you got 5, now you got 6, now you got 7, 8, 9, 10. You get up here and you get 10 contracts. All right. So that's called dollar cost averaging in. This is called dollar cost averaging out. So you're dollar cost averaging out. The disadvantage is if you're wrong when you first get in with that huge amount, boom, bad loss. The problem with this strategy is that once this market gets up in here, you start getting really top heavy. And this is where you lose all your money. So now you have 10 contracts. If that market moves back just this far, doesn't have to move very far because you've dollar cost averaged all the way up. So your average price, average entry is way up here. That's all it has to do. It only has to move back that far and you lose everything. And if it moves back even just a little bit more, now you've lost everything that you lost that would have lost down there, right? At this point. So if you hang on to it, waiting for it to come back, now you're upside down again. Now you got your pyramid you're building. You're trying to go with it this direction. So think of it like this. So you got your pyramid like this. So now you got a pyramid like this, right? And you're in the same situation. So now you've got a situation where you're going to try and liquidate out going up the pyramid, but you've built yourself into a pyramid where you're really got a dangerous location if the market just moves back a little bit. And since it's already moved up a lot like this, the chances of it just kind of having a little pop back like that could wipe you out. So there's advantages and disadvantages to both strategies. Now, the next strategy I want to talk to you about, that's a pillar. That's an upside down pillar. And then the next one is going to be a pyramid. I'm sorry, I said pillar. So that's your pyramid, your upside down pyramid. And then this one over here is your pillar. Now, a pillar is the one that doesn't make you as much money. It's a little bit more conservative, but it doesn't lose you as much money either. So you get a pillar is going to look like this. And let's not make it red because that's our loser. Come in here to our preferences and we're going to change that. We're going to make that, we'll make that green or gold. How about gold? All right. So now this is our pillar. And so how does a pillar work? Well, a pillar says we're going to get in the beginning with one or maybe two. I like to start with at least two. All right. So we start off with two. And then what we do is we do what I call castle. All right. So as the market moves higher, how can I example this? What you're going to do is you're going to get in here with two. Let's put that in there real quick. Quantity 2. And you can do this with quantity 3, quantity 4, quantity 5. It doesn't matter. This depends on what your risk tolerance is and how big your account is and whether it falls within the parameters of the other things we've talked about in our risk management strategies, right? So we're going to start off with, let's say, quantity 2. That's generally the minimum you want to start off with. And so the situation is if you're wrong, well, the loss is not nearly as bad. Now we got to go to the red. Keep our colors consistent. So now if we have a loss, we don't have a loss of, 10 contracts like we do over here. We start off with a smaller quantity, but it's greater than quantity 1. Now what we can do is when we dollar cost average and the market starts to move in our favor, let's say we add 1 in, it doesn't double it. It doesn't jump up 50%. It jumps up 33%. So it doesn't go quite as high. And if you feel confident, you can start with 3. You can start with 3 in here. And then when you add in your single, it doesn't even go up 33%. It goes up even less, right? So it doesn't dollar cost average and keep jumping your average so close to the market. And the same thing can happen here. If you don't add in, like if you don't keep doubling, which people have a tendency to do when they build their pyramids, they get in with 1 and then they want to put on 1. So that's a double. And then they have 2 and then they wait and then they add on 2 more and then they add on 4 more and then they add on 6 more and then they add on, 8 more. And they keep making their pyramid wider and wider. If you'll come in and you'll just pillar up and you start with 3, then you can pillar up, just go in 1, 2, 1, add 1, add 1, add 1. But as you go in, I want you to castle, take profits along the way. So now you add 1 and immediately before you add it, you add 1 in and then you take it off. And then it doesn't dollar cost average you up quite so high. You're going to have to practice this. You're going to have to go in and do it in your demo account and see what happens when you do that. If you get in with 3 and then you take 1 off and add it on, well, then your dollar cost average jumps up really close to the market and you're more likely to get into a losing situation. So if you'll add in first and then take off to take your profits, the dollar cost average doesn't jump up as far. You're not taking off as much profit, but that's okay, right? If you want to take off more profit, you would take off first and then you would add in. You're going to take off more profit, but then it's going to jump your dollar cost average higher. So if you go in and you add in first, so let's say we got 3, we add 1 on, that makes us 4, and then we immediately take 1 back off. Now our dollar cost average doesn't jump up quite so high. We don't take off quite so much, but we're also not building a pyramid that's going to kill us if the market drops back too far. So now what we do is we come in, and that I call that castling. So what you're going to do is every opportune time, and that's when do you add? And I'll show you. I like to do it. I like to add as quickly as possible, as long as the dollar cost average does not jump above my trailing stop. So to do this, you have to have a trend. This is not a scalp strategy. This is I'm going to build me a big position. I'm going to ride a trend up. So you're going to have a trailing stop. It's going to go up on some sort of a mathematical model or price bars back or whatever. And as long as your dollar cost average doesn't jump above your trailing stop, then you can add in as many contracts as it takes. And sometimes you can get up into these pillars, the market will move and you can start getting these pillars build up pretty big. It's kind of an upside down pyramid, but I would definitely never want to get my pyramid above my trailing stop. So you can build it up and you can get in a lot of contracts, and as long as it's behind your stop, and then take those profits off and then let it continue to go, move your stop up, you add in, it's going to bring it up, take a bunch off. So you're going to want to continually add in as you go up this pillar, but also take them back off. All right. So you're going to be just going up a pillar like this. And so what's going to happen is you're going to get up to the top. When you get up to this top of this thing, come on, draw one more. You get up here, and then when the market flushes and comes back down, you're not getting flushed out and losing everything like you would on an upside down pyramid. You only lose however many contracts you had in there. So if you had 3 at the bottom and you went all the way up that thing and you get up to the top and you still only have 3 contracts, well, you only lose the value of those 3 contracts, not the value of the entire pyramid, because you were taking off each time you put on, take it off, put it on, take it off, put 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 on, and get wiped out. And you only get wiped out with 3 contracts, and you've made money all the way up the pyramid. All right. Is it going to make as much money as if you rode it all the way up a pyramid like this, all the way up the pillar? Is a pillar going to make as much money as a pyramid? No, it's not. But is it going to be safer? Might actually make more money because you don't get wiped out at the top where you lose everything. But if you manage your pyramid okay, I mean, sure, a pyramid can make a lot of money. That's why people do it. But it's also very dangerous the further higher up you get. So it gets more and more and more and more dangerous, because just a small flush wipes everything out. Where if you take profits along the way, yeah, you might not make as much money if you were able to get out, be smart enough to get out right at the very top of the pyramid with all of your contracts. But we don't do that, right? We like to try and maximize. The reason we're building big positions because we think it's going to go to the moon, and then it doesn't. We wipe out our pyramid. We lose everything. You're going to make more money with a pillar, even though just a safer way of doing it. All right, so let's go put this let's implement this. Let's go do it. All right. We can't really. Bruce has a real good rule that he's going through. Bruce, he told me his strategy. I don't think he'd mind me sharing it with you, with the class. He's got a good idea, and I like it. You oftentimes will hear me say that the market likes to come back to that magic blue line, right? The VWAP. Now it's not less to the VWAP now. It's fallen in love with it this morning. It's just kind of hanging out on that VWAP. But here's what Bruce has been doing, and he says it's been working real well for him. But he's been getting a little trouble because he's been doing a little bit too much dollar cost averaging. So I wanted to give that lesson to you, Bruce. Maybe rather than building a pyramid, build a build a pillar instead. But what Bruce's strategy is he likes to wait till the market comes away from the market down here and starts to look like it's going to start to come back, right? And go back to the blue line. Because we oftentimes say that, well, that blue line is like a rubber band. It likes to go back to the blue line. So Bruce has been waiting until he gets a risk-reward ratio large enough that that the return to the blue line is worth doing, right? I mean, we have to have a market that's moving far enough to make it worth the effort to trade. Trading right here in this little section here is not worth it. It's not worth taking the risk. The market's not moving. It's not trending. There's no reason for it to trend. We didn't get any news. It's just dead. It's just sitting there. So to try and take these little green reds, we're going to just get our heinies handed to us. So that's why I always tell you, wait for the market to move first wait for it to make a nice, good breakout, and then anticipate that it's going to continue in that direction. It'll give us a little opportunity to get in, and then we'll take the next leg up. So if you just sit there and try and get in here for the leg up, get in here for the leg up, get in here for the next leg up, get in here for the, you're just going to get your hiney handed to you. Maybe you're doing the same thing on the way down. Maybe you're going to get in here for the way down. Maybe you're going to get in here for the break. Maybe you're going to get in here for the break. And you're just going to get killed as the market goes sideways. Wait for it to make its breakout. Wait for it to go. And it sometimes has false breakouts because sideways markets do that. Sometimes it'll break out and then it'll pull back and flush and go this direction. Well, that's okay because you're not going to get in unless it proves that it wants to continue to rally up out of here. If it just flushes, you won't get in because you're going to use an intercept order or a trailing stop. Don't use market orders because a market order will probably fake you out. And that's why we like to use those intercept orders. I'm losing my voice already this morning. Oliver's saying he's on board with that. He says take money along the way. So that's the way we do it. We like to take money along the way. All right. Now there's kind of little rules that you can learn, Oliver. Says I'm not that experienced, but I know how to take money along the way. So there's little strategies that you can use that we can show you good ways to do that. And one of those is to take your profits and never allow your dollar cost average to get above your trailing stop. And that's a good way to take orders along the way. I call it castling. So you add in and then you take right back off immediately. So that's how I like to do it. Add in, take off. Okay. All right. So Bruce is waiting for this market to come down here far enough that the distance from where the market gets down here and turns around and starts going back up has a nice profit potential going back to the blue lights. All right. Now, Bruce has been coming down here, and one of the struggles that he's been having is finding this turnaround point, right? Finding the opportunity to get back in and have this thing come back. So he'll get in, and he's been dollar cost averaging down. And it's been working okay for him. He started, getting in, and he's been building a pyramid. Now, this is an upside down pyramid for Bruce because he's starting small, and he's coming down here, and he's building this pyramid down here. Right? Let's start with the peak. Let's start with the peak. That goes like this. Let's build the base first. The base, and so he's building a pyramid like this. Now, this is okay because Bruce is looking for a turnaround. And as he builds this pyramid bigger, he comes down here and he starts building this pyramid. So he puts one in here in anticipation of a rally, right? He then adds another one, he adds another one, he adds another one, and he adds another one. The problem is if it doesn't come back, Bruce gets his hiney handed to him because he comes down here and he ends up with a pyramid that's way down here. Now, the advantage of this is, of course, if it comes back and starts moving back in his favor, his dollar cost average is way down here. And if he can get it above that dollar cost average, he's going to the moon with a huge pyramid. Okay. So this is the way institutions will trade. And you hear me talk about that all the time, where you go through the accumulation distribution model. So that's what Bruce is doing. He's using that strategy of building his pyramid after the market's already come down and getting down into this region here. And then he's saying, okay, I think the market's going to turn and go back to the blue line. And he starts building his pyramid. The only problem with this is, what if the market doesn't come and go to your blue line, right? What if it just continues to go down and you keep building a bigger and bigger pyramid, and this market never does come back? Now, there's something else to take into consideration. We talk about this with options, right? Where we have, where's my little options? Where is that little slide? Uh-oh. There it is. Where we know that the market has a tendency to stay within this 68.2% of the time, it stays within the 1-to-1 cone of probability, right? So this is your cone of probability of where the market's going to go. And so what Bruce is doing is waiting for it to get out into these outer regions and then anticipating that it's going to swing and come back in. If it doesn't swing and come back in, that's where this strategy fails on you. So what I'm recommending is Bruce, be very careful and set yourself some parameters so that what happens is, if this market comes down too far, you don't just go real deep into a no return world, and you end up, blowing your account up, which I have traded this strategy numerous times. And I used to do this for my, I used to trade like this all the time. And I made a lot of money doing it, to the point where if you were in my class, we used to go out and give money away, right? We would make a bunch of money. We got to charities and we would give the money away. And it was fun. It was a lot of fun, uh, until we blew the count up, right? And we blew up 2 accounts doing this, because the market sometimes just doesn't come back, and it just keeps on going. And if you just keep dollar cost averaging in, thinking, well, I'm just going to keep going with it because I know it'll eventually come back. That blue line's up there. I know it'll come back, and it doesn't come back. And then the end of the day comes, and you can't hold it because of margin amount. You got to give it up, and boom, your whole account's gone. It's destroyed. And I know that's how Aiden Gray, you read his article. That's how he blew his account up several times, trying to dollar cost average and doing this strategy right here. So the way you keep yourself from getting into that trouble is you have to set yourself some parameters. And so what are those parameters for you? I don't know. I don't know what you're going to do. I don't know how big your account is, what your risk tolerances are. But my parameters are is I don't like to risk a more than a certain percentage of my account. But when you start dollar cost averaging in like this, you kind of throw that out the window, because you can't, it's like, because you immediately start going past that 2% rule or that 3% rule. I mean, almost as soon as you dollar cost average once or twice, you're throwing that out the window. So then you have to say, okay, well, I'm only going to dollar cost average a certain number of times. I'm only going to dollar cost average once. I'm only going to dollar cost average twice. I'm only going to dollar cost average 3 times. And you're going to build this pyramid in anticipation of the return of the market. So my advice to Bruce on this strategy is to also wait for those recurring price patterns, watch those indicators, and watch those 3 drive patterns, and only do this on what we call the 3rd drive. Only start building your pyramid down here once the market has given you 3 drives, because the market has a tendency to do 3 drives down, right? And if you start trying to build your pyramid right here, doesn't mean it can't turn and go up and make you money. It can. It will sometimes. But you're being rewarded for doing something dangerous. All right. So then you say, oh, I'll wait for the ABC retracement. I'll wait for the 2nd drive down. Okay. Same thing. It could come back and pay you, and you're starting at the 2nd drive, and it could go back. But if that 3rd drive wants to kick in there, and the market has a tendency to do those 3 drives, you see it all the time. I point it out to you all the time. Down here is probably the best place to do. Wait for the 3 drives. And you're like, well, I might miss a lot of trades because it goes back on the 2 a lot and it goes back on the 1 a lot. Yes, that's true. So if that's the case, you're going to have to give yourself some more strict rules up in here. If you're going to say, all right, if I'm going to take it on the 1st drive back and I think it's going to go back up just off of this little ABC bottom formation, then you better not take as big a risk that you might take on this and a little bit bigger risk on this one. And then on this one, you can take a little bit bigger risk, right? Because the odds become higher and higher in your favor of going in your direction once it's made the full 3 drive pattern down. And realize that's why we call it the A drive has the highest probability of continuing in the direction. And if you're trying to catch the reversal, well, you're going to be in trouble. 2nd drive has the medium chance of coming and reversing, going up. So that's why we will wait for that 3rd drive. So if you'll wait for that 3rd drive before you start building your pyramid, you're going to have a higher chance of having a successful pyramid and have that market turn around and come back against you. So you're going to have to set yourself parameters and decide where you're going to exit your position. You might only dollar cost average once on the A drive, twice on the B drive, and 3 times on the C drive, right? On the 3rd drive down, you might be willing to take a larger position down here because the chances are more likely to turn around. Now, I would wait for the market to turn around. What I would do, and what I like to do if I'm going to do this strategy, I don't do it so much anymore, but we all dollar cost average a little bit. On occasion, we all do it. So I would wait for it to prove that it wants to make that ABC bottom. Okay. Got so many arrows in here. Let's redraw this. Let's delete just the arrows. So you're going to get your 3 drive pattern like this. And when it comes down, we're going to look for that ABC retracement and look for that ABC back up, right? So what you're going to try and do with your dollar cost average pyramid is you're going to try and capture, and I like to do it right here. This is where I like to try it. I like to try and get this point right here, because this is your head and shoulders formation, right? So you get your left shoulder right here. This is your neckline. This is your head. This is your neckline. This is your right shoulder. And then it's that break that we're always looking for, right? We're always looking for that break So that little break in there. So here's your little break in there. And so when we get that higher right shoulder, higher highs and higher lows, that's where I would start be willing to build my pyramid. Now, if that fails, the problem with that, the reason it fails is because that's probably not going to follow through. So you're going to be going against, you're going to, you have to realize that you're at the bottom of the third trend and this is where it's supposed to go. So you might start building your pyramid right here and it could fail and just come right down. But that's always the risk. The pyramid could fail. It's just, where are you going to start building your pyramid? Are you going to start building your pyramid here? Are you going to start building it here? Are you going to start building it here? Okay. So where are you going to build your pyramid? You can start building it here where you're anticipating the market's going to go up and you're not going to, you're going to go in with a small and you're going to pillar. That's the whole name of the game, right? If you're not going to pyramid, then at this point, this is where we're going to start pillaring back into the market, back to the blue line. So we would pillar if the market continues to just go up. If it doesn't, if it starts to come down here, this is where you start to build your pyramid. And at some point, you're going to have to tell yourself, well, I'm not going to continue. But I have a higher likelihood of the market rallying up from down here than I do from up here. So I'm willing to take maybe 3 or 4 dollar cost averages in here, or I'm only willing to do it with 1 or 2 here, or 2 or 3 here, or, 3 or 4 here, or, at some point you have to give yourself some parameters and say, I'm not going to do it anymore. I'm just going to take the loss. Now, the one thing that you can do is you can pillar on the way down. So for your risk management, you can pillar on the way down. It doesn't have to be a pyramid. You can come in here and you can start building a pillar, okay, to the downside. People don't like to do this because what happens is as the market comes down, you pillar upside down. You build your upside down pillar. So as the market comes down, you add in and then you take off and you take off and then add in, take off and add in, take off and add in. And you're doing a downside pillar. So you build and then take off and build and take off. Each time you take one off, you're taking a loss. So you're cutting your losers as you pillar down, right? Rather than taking a profit, you're taking a loss. But the further it goes down, but you're not building a giant, huge, actually your pillar would go this way. You're not building a huge base at the bottom of your pillar, right? So you can pillar down instead of build a pyramid down. And it might be a little safer, but you're also taking losses, and nobody likes to do that. Nobody likes to take losses on the way down in anticipation of a reversal. They want to just keep building, and so they bring that dollar cost average down, which just keeps building that base bigger and bigger. And the disadvantage of that is, man, eventually, if that market doesn't come back and give you a reprieve, you just die. Now, here's the other mistake that people make, and mistake that I've made. And I've learned, again, my testimony is that if you start going down and you start building your pyramid and that pyramid starts going down and actually it's the other way. Let's draw this the right direction. You start building your pyramid, right? And it starts coming down like this. And then if that market ever comes back to where your dollar cost average, let's say your dollar cost average is right here, and you've had to go down 6, 8, 9, 10 contracts to get down here, and you keep pulling that dollar cost average down a little bit more, a little bit more, a little bit more by adding in another position. Eventually you get to a point where it doesn't matter. The market can stay irrational longer than you can stay liquid, and it doesn't matter. You start putting contracts in, and that dollar cost average doesn't move. You'll put one in and it doesn't move at all. You'll go, oh crap, I'm in trouble. So if this market comes back, and it'll oftentimes do this, it'll come back right to where it feels like it comes right back here, and it'll give you a reprieve. You could get out with 0 profit or 0 loss. And so you could get that market come back to your break even, and you don't take it. And you're like, oh, now I'm going to be rich, rich, rich beyond my wildest dreams. I've worked all afternoon to build this huge position, and now it's going to go back, and I'm going to have this giant, giant profit. Well, you've got such a huge amount of danger on there. At this point right here, if you've built yourself a massive position, your tendency is to want to stay in and let that thing go and make $1 million. I'm bearing my testimony that your best idea is to take a lot of that exposure off right there at break even. Get your exposure off. If you got too much exposure, take it off immediately. I know you don't want to. I know you want to hold on to it. I know you want to drive that thing to the moon. The problem is it comes back, it says, "Hey, Lan, I'm going to let you out because you know what? I'm going to tank this thing one more time. And I'm nice to you today. I'm going to come back and I'm going to let you out of that position. Go ahead. You better take it off right now because I'm going to drop this thing one more time. And if you don't get it out, you're never getting it out and I'm going to wipe your account out." So I have learned from experience and I have learned from seeing lots of other people trade like that where they don't take it off. They had the opportunity to take it off. They didn't reduce their exposure and the market didn't go for them. Instead, it dropped and they wiped their accounts out. Now, the thing is, if you got a lot of stamina, you can come in here, take a lot of that exposure off, and then you can start building another pyramid down here. Okay. So you can then start building your next pyramid at that point. All right. So keep that in mind. Take that exposure off. If you've been, you've got parameters. I'm willing to do this 3 times. And at 3 times, if the market's coming back and it starts going back up, then go ahead and hold it and let those 3 ride and take them off as it goes up and pillar that thing all the way out. Build a big pillar, off of this thing. So you've built your pyramid. So now use that as your pillar going up. Where's our pillar tool? Here it is. So you start building your pillar and you take your pyramid and turn it into a pillar and start pyramiding up, pillar up. But if it comes back and you got too heavy, like you're like, oh man, I really got way over my skis on this thing. Get some of that exposure off so that if you have to start building more pyramid, you can, and it's not going to wipe your account out. And then you can start doing your pillar from down here. All right. You say, well, Lan, why don't I just do that up here? Well, you can start a pillar there, start a pillar here, start a pillar here, a pyramid here, and you can dollar cost average in a little bit like this, right? Build your pyramids coming down that Elliott wave pattern, those 3 drive patterns. And then just have yourself some parameters and say, well, I'm not going to pyramid more than twice. Well, you're going to have to take a loss. You're not going to pyramid more than twice. Okay. 3 times. Okay. You're going to take a loss. Not going to pyramid more than 4 times. Okay. Take a loss. Try to get back to reprieve. But all of these are trying to turn into pillars, right? You're trying to put pillars on all of these. So that's the whole name of the game. All right. I hope that wasn't too over your head. Let's get back here real quick and come back to all the way up here to these pillars. Where are they? Pillars? There they are. Okay. So what is a pyramid? A trading strategy where we start with a large position size and reduce our holdings as the market moves in our favor. The pyramid is a risky approach where the largest position is held at the beginning of the trade, amplifying potential losses. What is an upside down pyramid? A trading strategy where we start with a small position size and increase our holdings as the market moves in our favor. The upside down pyramid is a risky approach due to holding our largest positions at the least favorable price, the top of the trend, where we have the lowest probability of trend continuation, amplifying our potential loss of unrealized gains. What is a reverse? A dollar cost average pyramid, a trading strategy where we start with a smaller position, but when we're wrong, we don't get out. Instead, we continually add to our losing trade, dollar cost averaging down, building a bigger and bigger pyramid base. The reverse pyramid is a very risky approach where we quickly build a massive position on the wrong side of the market trend. Markets can stay irrational longer than we can stay liquid. Key point, the pyramid building can lead to significant gains. The risk of substantial losses are heightened due to these strategies. In all 3 cases, taking on large position size, big risk, big reward, big risk, big loss. All right. So that is your pyramid building. Here's the pillars. What is a pillar? A trading strategy where we start with a less aggressive starting size, usually greater than 1 contract or in futures, then dollar cost average in and out of a winning trade, taking profits along the way. This is not a dollar cost average into a losing trade strategy. For example, step 1, enter with 2 contracts. Step 2, at the appropriate point, add another contract, dollar cost averaging into your winning trade. Then immediately take it back off, reducing your size back to 2. This takes approximately 33% of your profit. I call this castling your trade. General rule, when adding into your pillar, never let your new dollar cost average position exceed your trailing stop exit price. Only add into your pillar once your trailing stop is above the new average price level. Pillaring is a more stable, consistent risk reducing strategy. Positions are evenly distributed and maintain a more balanced risk profile. Key point. Pillars represent a substantial approach, a sustainable approach, focusing on the long-term stability and minimizing large potential downside risk. Pillars are especially popular with new traders and or more conservative traders who have a lower risk threshold. All right. So there you go. That's pillaring. You can have these slides. They're up here at pitnews.com/slides.pdf. And where did my charts go? Oh, they're over here. How did that work out? There we go. All right, so let's get rid of all these drawings. Hopefully that was helpful. And this market's not really doing a whole lot today. Is it started to move? That's our setup right there, isn't it? It's trying to go higher. Let's take one. We're going to go ahead and pop that in there. See if that market won't go up. That's just let's do a scalp and trail on this. Put two of them on, drag one out here. So we got two trailing stop. We got one that's going to go up. We got the first green candle to make a new high. Going to try and scalp one as it tests this high right here. Let's bring this full screen. So there's our little pattern, right? Now, do they always work? Nope. But we want them to work at least, 4 out of 10 times, right? 4 out of 10 times, it's still a profitable strategy. So 4 out of 10. So we do this 10 times, we should win at least 4. Anything above 4 is more profit. Anything, if we only do 3 out of 10, then that's not good. Then we start losing money. But if we do this strategy, remember, 10 times, we should win at least 4 of them with a risk-reward ratio of 1 to 2. And if that's the case, we can be profitable at this. So we're just looking for it to come up, and this is the scalp. We want to see this market continue higher. If it fails here, well, we're just going to get right back out. I'm going to set the trailing stops. Not pushing higher, is it? This is scary. This is scary. Okay, wimpy little market. We're not going to trail on the ATR. I'm going to trail price bars back, and I'm just going to go 1 price bar back. Go 1.1. All right, move that up there a little bit because this market needs to move. Come on, buddy. Jump up there, pop up above that previous high. Oh, come on, push her up there, push it up there. Okay, now this one's trailing on the yellow dot. So that's our trail. So this is our scalp and trail strategy. Now it's failing on us. Went up, tested that previous high. And oftentimes I will put that on the inside of that previous high. If I'd have done that, that would have taken the profit, but I was waiting for a 1 to 2 risk reward ratio. But then I moved it closer, and this thing's just going to fail on us. There's no reason to let it come down and take the rest of our money away. We're out. Oh, what a worthless market. If I'd have put that trailer in there, if I'd have put that limit over down below there where I usually do that, I usually like to take my profits. You've heard me say it a million times. I don't want it to have to push past there to take my profits. If I'd have put it on the inside of that resistance zone, we'd have had our profit, but it'd been smaller. But we did move our stop in, so we did have a smaller risk. So it still would have been a 1 to 2 risk ratio on that scalp. What if it starts to go now, Lan? Well, you can try again. Usually what we do is we wait for it to break this time. It went up and failed, so that's not good. So that can take a reversal. You can say, well, maybe it's going to fall, and that's a little 1, 2, 3 double top formation. And then at that point, you're like, well, it's not strong enough to go any higher. We're on the backside of the MACD. We could take a short position and anticipate it's coming back down to the blue line, right? Back down to the VWAP. But my inclination is to see if this thing's not going to try and break higher. Didn't even go far enough to take our scalp off. What a rotten little market. All right. See what else is going on. All right. Everything's flushing back down. Look at the Russell's flushing. got our first candle. Lan, you said to go short. Now why didn't you do it? All right, let's put one in there anyway. Getting in a little late. It'll probably pull back against us a little bit, but we'll see. Here's where we can come in here and let's delete. Let's do this. Let's delete these. And we're going to build ourselves. Let's do a little dollar cost averaging. All right. Let's come in here and to the short side. But this thing is long. I mean, this is not a good place to be taking all these. But we're going to do it anyway. Okay, we're going to do it. We're going to come in here. And we're going to say, okay, we got one here. We're going to add one in. So we're going to take our limit and we're going to put it up here. And if it breaks above there, we're going to add a second one in. And then we're going to take a limit. And we could do 1, 1, 1, 1, 1. We could say here, this is more conservative, but it doesn't pull your dollar cost average in as fast. All right. So we're going to set these in here. Usually you want to set them within even numbers, and you like to have them inside of these even numbers because the market likes to go to these even numbers, right? So this is our dollar cost average. This is building Balaam's ladder, right? So we come in here and put one up here too. So that's 1, 1, 1, 1 Balaam's ladder. Now, the problem with this strategy is that if it hits it, it pulls this one up 50%, and then it only pulls that one up 33%, and then even half of that, and it's small, and it's incrementally pulls your order up smaller and smaller and smaller, and it gets to the point where it doesn't do a whole lot of good, right? So if we come in here and redo this, this is the true Balaam's ladder where you're really playing with the devil. So we're going to come in here. The first one's going to be a 1. We'll put our order in here. We'll take, if it breaks above this high, we'll add into a second position right here where most people are getting long. We're going to take a short, right? And that's what we did. We took long and it come back and snapped us out. So now we're going to come in, and this time, now we're in with 2. So we're going to do 2. We're going to add 2. So that's going to bring us up 50%, right? So we're going to come up here. And where do we want to put it? We've got a line right here. We could come up here to this line, but that's a long ways away. So we could put it right halfway between those two. So that's going to double it. Now we got how many we would have in that one? We'd have 4. So now we have to go 4. So we go limit, and then we're going to bring this up. And maybe at 4, we're going to put them in right here. And let's go ahead and bring this full screen. And this is a way to dollar cost average. If you bring these too close, then your dollar cost average doesn't do you a whole lot of good. And then you just kind of dollar cost averaging in here. And this trend can easily go that far. You know, boom, that's $300. You can easily go that far. That's what we were expecting here, right? A continuation of that uptrend. So you want to kind of really make sure that these averages move for you. So now we got, this would be 4. That means we'd have 8 on. So we'd have 4, 5, 6, 7, 8. So now to double it, we're going to have to go to 8. So now we put a limit on up here. And this is why this strategy works better with a micro account than a mini, depending on the size. See, we're already running out. We can't do it. That's it. That's all the money we got. So then you start saying, well, Lan, why do it like that? Why not come in and do your 1, 1, 1, 1, 1 instead of going 2 up here? We'll take this and we'll go to 1. We'll put a limit. We'll put a 1 here and change this one to 1. Well, you can do that. You just put more orders in, right? And now instead of having 4, we don't double it right here. We start going in with 1, but we do them closer. 1, and then we go 1, and we go 1, and we go 1. So we still get our 4. We just bring them closer. And then that would bring your dollar cost average down, right? So this way, if the market comes up, and then eventually turns and falls, that's the name of the game, right? But the biggest problem is, what if the market doesn't turn and fall and it comes up here and then it falls here and then it goes here? So my recommendation would be not to dollar cost average. My testimony is, don't do this type of a strategy on days where we have big economic moving news days, because those are the days that are going to be more likely to have the market trend and push higher and make big trends, right? Your strategy of doing this is that it's got to be kind of you're trading in basically a narrow sideways channel. You don't want a trending market. You want the market to just kind of roll back and forth through the snaky pattern of the VWAP, volume weighted average price. So if you're going to have a nice big trending market, if you got good news, you don't want to be trading this, because the good news, the market's just going to take off and go without you. Now, here's a situation where we took a short position. We only went in with one, and we put all our orders up here. Oh, and we're only in with one. If this market would have come up a little bit, at least come up here and broke and, gone up here and then fallen, we'd have been able to get in with 3 or 4 contracts. And then we could have pillared all the way down, right? And that would have been a fun strategy. And that works great until it doesn't. The only thing, this is a great strategy. I love it. Made a lot of money doing it. So much money, I was giving money away to charities until it stopped working. I mean, until you get into a trending market. I mean, the market's dead. This is a great strategy. Where it kills you is when you get a trending market. So you can't trade this against a trending market. You're going to die. Now you can come and start building a pyramid this way too. And when you start getting cocky, like I did, you come in here and start building it going the other direction. Now you come in and you start taking your profits off like this. You're only in with one. I want to take my profits at the blue line, and then I'm going to start building my pyramid going this way. Right? Because you're going to trade the channel. So now I'm going to come down and take my profits, and if the market continues down, come on, take it. Take it right there at the blue line. Touch it. Oh, I'm right there. We're going to bring a stop in from the top. I don't want to. Oh, we got it. Didn't have to bring my stop in after all. All right. So now what we do is now we just let this build this way. I have seen automated trading systems that actually do just this. And I've seen it done in the Forex market, because the Forex market has a tendency not to trend very well. It just wanders back and forth through snakies all the time. It's really hard to trend. And so this is an automated bot style system that trades like this. And they will run it like this outside the cone of probability, right? So they set it up, so they got their cone of probability, and it's all automated. So this is a quant style trading strategy based on the cone of probability. And so what they'll do is they run it like this, and then they'll put their, they'll go 5, 6 legs out, 1, 2, 3, 4, 5, and then they'll take their 5 and they'll put their stop way out here. Okay. So this one here, we got, what do we got? 1, 2, 3, 4, 5, 6. We're into this one 7, but we could take this one off and do the same thing. So 6, 5. So now we got our 5 out here, and they'll bring this in a little bit closer. They want to like this. So I've seen quant mathematical models that do this. So they set them up like that, and then they'll put their 5 out here. And then they just let the bot, they just let the system trade it. So that's how they do it. They'll just sit there and trade it like that. Do they make money? Yeah, they make money until they don't, until the market starts trending. And then that bot gets its hiney handed to it too. So I would suggest that if you want to trade like this, you manage a little bit better, set yourself some parameters. How far are you willing to let that market go before you're going to wait for it to turn around or get yourself out? I recommend, if you're going to go on the minis, you go with 3. You let yourself go out 3 times, and I like to space them a little bit farther. So we get in with the first one, wherever your entry is going to be. And I don't like the idea of just bracketing the market like that. I like to be more strategic and wait for the signals that I think the market's going to go. And I'm going to try and trade just like I normally would, and only do this as a backup strategy. And then I like to make these things have like a more staggered entry. So it has to go farther. So have the first one a little bit closer, then the next one a little bit farther away. And if you're going to do one more, so the idea is that it's even farther away. So see that? So the gap is really kind of move. Then the market might come down here and, come around and then come back. And it's just going to pull your dollar cost average in a little deeper into your pyramid. All right. But at some point you got to call uncle, you got to yell uncle, you got to get out. The other side of it, I mean, there's just so many ways to do this. The other way to do this is to, have it here and then here and then here. So you might go a little bit tighter and tighter and tighter. But there's just different ways to do this, skin the same cat. It just depends. Rather than just being random like this, I'd be more likely to want to look at areas of support and resistance of your previous trends. Of course, we don't have anything at all today to go off of. But if you got your previous trends, you're going to use those areas of resistance as areas to take positions. If the market breaks through the area of resistance, that oftentimes will break through and then fail like it did here. And then that would be a good place to take your position and go the other direction. All right. So that's dollar cost averaging, pyramid building, and quant style trading strategies all rolled up into one, and pillaring. Oh, and you're not seeing the chart. Oh, my hell, man. Sorry about that. I don't know how that happens. I'm so focused on this chart, I don't see what's happening for you guys. So the point was, I was just trying to show you that you can quant style trade this. This is how the quant style, I don't know how far back I went. The point was just different. I'll have to go back and watch the video and see if there's something in there that you guys missed that I think is worth seeing. It's just different distances between your orders based on areas of support and resistance. That's really what I was trying to say. And how far out you're willing to go before you call uncle and get out. All right. I'm going to go through and see if anybody has. Oftentimes I go read the comments after I close down, and then there was great questions that I missed. So I want to read down through the comments here quick. Bruce says we had a good conversation. It was a good conversation. Hopefully, Bruce, this is a little bit helpful of what we've added into here today. Oliver, we mentioned that. I says, I don't have that much experience, but no, it's better to take money along the way. Much more sure, take money along the way. So we got that out. Another good comment by Oliver. You got to control your risk, right? Michael Bruce. He says, this market chopped my demo account to death today. This is the last time my pyramid and pillar. Actually, it's the other way around, Michael. If you pyramid and pillar, you don't get chopped so bad because you don't ever get out of the market. It's rare that you actually ever hit a stop. Your orders just kind of fail and you just stay in the market forever. You don't ever get out. So your stops are so far away when you pillar and pyramid. You come in here, your stops are way out here. So you get three. So you put your stop way out here. So if the market just kind of wanders back and forth, you never do get stopped out. That's one of the advantages of this. This thing keeps coming back and forth like this, right? Well, you got one position and it never did stop you out unless you took a profit. I mean, if it went from here to here, that takes your profit off, and then it goes back, keeps going up. You put another one in, then it comes up here, put another one in. You don't get stopped out till it goes way up there, comes back down. That's the idea, is to, go like this, and you never get stopped out, because to get stopped out, it would have to trend, and that's clear out here and clear out here, right? You might have a stop down here. We have 4 on the downside. We'd have to have 3, 4. You have your stop way down here. So the whole idea of this strategy is you never get stopped out. People like that. The only problem is when it starts to trend, you get stopped out, and if you're too heavy into it, it wipes your account out. Mike's also saying I see that the VWAP goes to the current price. The VWAP does move. I mean, if you got a trending market, the VWAP will move. So the market will move up and the VWAP will start to climb. It makes it easier for it to return to it, right? Okay, we just dollar cost averaged in accidentally. I left that on there and wasn't paying attention. I didn't really want to take another position. So we'll let that sit there, but well, I'm getting ready to close this. I don't want to, we're going to take that off. All right. So let's see what else are we coming in here. So Michael's saying, I don't like to take new positions at the VWAP. It must be above or below. So that's kind of what Bruce was saying. He wants to wait for it to get away from the VWAP and come back to the VWAP. Now, a lot of people will do just that, Michael. They'll come in and they use the VWAP as their area of support or resistance. And so that's why the VWAP, let's turn off the ATR. Oh, that's not what I want to do. What did I just do? Come back into the VWAP. Now, if we go to our VWAP settings, you can turn on the arrows and people will take the VWAP. See, that's a possibility. You can do that with the autopilot. And it's like, if it's above the VWAP, the market's bullish. If it's below the VWAP, the market's bearish. They'll wait for it to cross back and forth across that VWAP. And like you just experienced today, you're like, man alive. I tried to go long the VWAP back and forth across the VWAP and I got my hiney handed to me. So yeah, but a lot of guys will do that. They'll use the VWAP as the support resistance area. In fact, you can use that as your indicator in the autopilot. You can go into the autopilot and say, I'm going to take the arrows from the ATR, right? Only if it's above the VWAP, only if it's below the VWAP. So in your autopilot, you can come down here and you can say, I want the trend, and then you can trend of the off. This is the YM, and then you can say VWAP right here. So now you're going to take the ATR on your signals, but only if it's above the VWAP or below the VWAP. So that's a very popular common way of doing it too. I'm going to make this thing so you can see both. I was always covering something up. Always covering something up. So anyway, that's the kind of the way you can use the VWAP as your trend indicator, and that's how it's done with the autopilot. Let's see what else we got in here. Oh, Oliver's making a comment about the trade miner. We were going to do, Oliver, was that you, or Bruce, was that you? Somebody made a comment, said we should do trade miner every Monday. And I said, that's a good idea. We should do trade miner every Monday. I guess I need to put that on my calendar because I forgot. So Oliver had a good trade on lean hogs that we talked about last week on the seasonal nature of markets. So we need to start doing that every Monday. We should do the seasonal trends, do trade miner. That's a good idea. I need to write that on my calendar and remember to do that. All right, Bruce, glad that was helpful. He says that he's been doing it in his strategy. He says he's been waiting for it to get at least $200 away from VWAP before he looks for it to return. So if it's $200 away from VWAP, that's not very far, Bruce. Unless you're, that's pretty close. That's pretty close. Unless you're doing it in the micro minis. Well, micro minis, $200 on the micro mini would be $2,000 in here. So that would be a bigger move. So 2,000 on the micro minis would be, that's a long ways away. Yeah, that'd be way down here. So the other thing that Bruce has been doing is he's like, I'm not waiting for it to come all the way back to the VWAP 100%. He says, I want it to get down away from the VWAP. And then when it comes down, let's say he's doing it like this. Let's say he gets a ABC Elliott wave down. He doesn't wait for it to come all the way back to the VWAP. Although Bruce, if you did a pillar, it doesn't matter how far back it goes. You could just pillar it all the way until the pillar finishes out. But Bruce has been putting his limit order to take his profits at 50% back. So he comes in here, and from the VWAP to where he gets in, he gets out, takes his profit. That's his profit zone right there. So that's where Bruce has been taking his profit at that point. So if he's $1,000 down, then he's $1,000 back. Or he's $2,000 down. Sorry, $2,000 down, and then he takes his profit at $1,000 back. So you could also pillar out of that thing if it's going to move that aggressively back towards the blue line. You could pillar into it, pillar out of it, and just let that trailing stop determine where you get out, and just keep taking your profits along the way. He says that's a minimum dollar amount. So he wants to get it away from the, yeah, that's the idea, right? You want to get outside that cone of probability that we talked about here. So get outside that cone of probability so that's going to return to the center point. All right, guys, we kind of run out of time, and I want to start trading. So, I don't know if I'm going to trade today. This market's so crappy. Not sure if I want to. We'll watch it. We'll see it. Be a good day to sell some options premium. Hey, before we go, let's go do our spreadsheet. We always like to do the spreadsheet, right? So we come in here. We accidentally made some money today, $205. 205. All right. So it's always good to learn how to do your, come in here. We'll write our little note. Got to do our journaling. Exampling, pillars, and pyramids. Made 205 on a dollar cost average entry. Actually, we didn't even dollar cost average. We put our dollar cost average in, but we used limits instead of stops, and we didn't get out. The market just took the reversal, actually, didn't we? Made 205 on a reversal of a failed ABCD pattern. That's what we did. All right. We accidentally made some money today. That was good. So we got to come in here and make this green. Did we hit our goal? We did. Our goal was $91 with this account, right? So we hit our goal. So, all right. And the thing that we need to do, I'm not going to do it right now in the interest of time. We need to go in and we need to put in there the strategy, right? So in here, we'd come in and fill this in and say, this was the strategy, the 1, 2, 3 ABC. It was a failed strategy. It failed, and we did a reversal. So that would have to be a third different strategy. Well, we reversed our position on a failed 1, 2, 3, and we made money. Well, how many times has that happened for you? 10 out of, 6 out of 10 times, 5 out of 10 times. We want to see how that works. All right. Michael Bruce says he's already got his chicken wing on. So that's selling. Michael Bruce, did you sell some calls or did you sell some puts? Because we got the put side, we got the call side. I know you like to do the call side. You like to sell the calls. So this market's starting to fall. So if you're selling calls, so you got puts on down here. You sold some puts. This market's coming down towards you. You might have to roll. So he sold the puts. All right, guys, I'm going to let you go. Do all those YouTube things. Subscribe, recommend, ring the little bell. Give me a little thumbs up if you like this. A little thumbs up is always good and helpful. I like to see the little thumbs up. Lets me know that we're on the right track. So I appreciate you guys coming, hanging out with me. I have a lot of fun doing it, and we will catch you guys tomorrow. Have a good Valentine's. Make sure you go give your sweetie some flowers.